Welcome to The Explainer. Today, we're going to unpack one of the biggest puzzles in fintech right now, the SoFi paradox.
So, we're diving into the really curious case of SoFi Technologies. This is a fintech company that is posting just blockbuster results. We're talking record profits, soaring revenue, massive user growth. But the market? Well, its reaction has been confusing, to say the least. After a spectacular earnings report, the stock actually dropped. So, what is going on here?
All right, to get to the bottom of this, here's how we're going to break it down. First, we'll look at that core paradox. Great performance, weird stock movement. Then, we'll dig into the phenomenal growth engine that's just firing on all cylinders. After that, we'll pinpoint the one key weakness that has all the skeptics worried. We'll see how this whole split narrative is dividing Wall Street. And finally, we'll look at what's on the road ahead for them. Ready? Let's dive in.
Okay, so this is really the heart of it all. On one side, you have this story of a company that is absolutely crushing it. And on the other, you have the story of a market that's just not fully convinced.
So what gives? How can a company that seems to be doing everything right see its stock get punished after such a strong report? It's a classic battle between stellar fundamentals and kind of shaky market sentiment. Let's start with the good news, because honestly, there is a lot of it.
So in its recent Q2 earnings report, SoFi didn't just meet expectations, it totally shattered them. We're talking record numbers pretty much across the board.
I mean, just get this. The company added a record 850,000 new members in a single quarter. That is a massive wave of new customers, bringing its total user base to nearly 12 million people.
And all those new members? Well, that massive growth translated directly to the top line. Revenue growth accelerated to its highest level in over 2 years, which is a super clear sign that SoFi's strategy is really paying off.
In fact, SoFi is so far ahead of its own guidance that Wall Street can barely keep up. Current revenue estimates for this year are about 25% higher than what analysts were predicting just a year ago. So, what's fueling this fire?
A huge part of this crazy outperformance is thanks to a relatively new venture, the loan platform business, or LPB. This is where SoFi uses its platform to originate loans for other institutions. Now, the genius part here? They get to collect these really nice high-margin fees without taking on all the credit risk. As one analyst put it, this new business caught absolutely everyone off guard.
And the LPB has just supercharged the entire financial services segment. Management had originally set a really ambitious target of 50% compound annual growth, but in the second quarter, what they deliver? A stunning 106% growth. That's more than double the target.
And it's not just the new ventures either. SoFi's core lending business, their bread and butter, is in what one analyst called fifth gear, growing at 32% and just crushing its 15% target. But even with all this incredible news, the story isn't perfect.
Right. So despite the stunning results in lending and financial services, there is one pretty significant weak spot that's giving investors pause. One analyst didn't mince words, calling the underperformance of SoFi's technology platform segment, which you might know as Galileo, the one black eye for the company. You see, Galileo was once hyped up as the AWS of fintech. You know, this foundational tech layer that other financial companies would build on top of. But the reality, well, it just hasn't matched the hype. The tech platform is falling well short of its 25% growth targets, and a recent CEO change there is only adding to the uncertainty. And this weakness, this is exactly what the skeptics are focusing on.
So that brings us to the market's reaction, and really the heart of the paradox. With this mix of incredible strengths and one very notable weakness, Wall Street is deeply divided on SoFi's future.
You can see it right here. The consensus rating among analysts is just a lukewarm hold. There's no clear agreement at all. While some are bullish, an even larger number are just kind of on the sidelines or are outright bearish. And this divide is captured perfectly in the analyst price targets. I mean, look at this. They stretch from a very bullish $31 all the way down to a bearish $14. That is a massive disagreement on what this company is actually worth.
So the primary reason for all this caution? It's what the pros call a rich valuation. With a price-to-earnings ratio over 50, investors are paying a premium. Think of it like this. You're not just paying for the car as it is today, you're paying a high price for the promise that it's going to become a race car in the future. And that brings us to the road ahead.
SoFi is at this fascinating crossroads. It's proven it can execute, but now it has to keep doing it. all while carrying the weight of these super high expectations and trying to fix an underperforming part of the business.
Now, the company is already trending well ahead of its ambitious 2026 earnings guidance, but the next 18 months are going to be absolutely critical. All eyes are going to be on the next major checkpoint, the Q3 earnings call on October 28th.
And looking forward, there are several catalysts that could unlock even more growth. Changes in student loan policy could drive more business to SoFi. They're also making a renewed push into crypto and blockchain payments. And all the while, that super high margin loan platform business just continues to scale.
And this leaves us with the final crucial question, right? SoFi has a powerful growth engine and a proven track record, but its premium stock price demands near-perfect execution. The upcoming earnings call is going to be the next big test. Will execution continue to trump skepticism? We'll be watching. Thanks for joining us.